We have a chilly market that is starting to warm up. It's showing signs of warming up, not getting crazy hot, but we see things picking up. Buyers are still requesting inspection negotiations or possible price concessions, as you've heard. And we're having trouble making flips pencil because the after repair value price is not as far from the current needs work price as many buyers would expect. And investors, due to cap rates, are really looking a lot towards single family homes. Investors who formerly would have looked at the fourplexes that we have so many of in Idaho have said, gosh, if a fourplex cap rate and a single family home cap rate are almost the same, well, which one's easier? And they're looking at more newer single family homes. And we do know there's new inventory out there to use to eat up. So and then, of course, with the ADU rules loosened in Boise, that's another opportunity to take advantage of an ability to add more cash flow to an existing property by adding an ADU. And finally, we may be past the big inflation spike, but we're still seeing that building costs and repair costs are in some cases prohibitively high. That's the gist of what we're seeing out there right now. We also had an economic forum, a forecasting forum recently that Stewart Title put on. And that was really telling in headwinds, tailwinds, turbulence, but everything is still moving forward. So, number one factor that affects the housing market. Who knows what it is? Shane, you know what it is.
I was just going to say time.
Yeah, you know that one too. Timing is the number one factor on whether you make money on the real estate market and how much money you make on the real estate market. But thinking of your daytime activities, what's the number one factor that immediately influences the housing market?
Jobs.
Rates.
Jobs, rates. Yes. So when we look at jobs, and we're going to talk about both of those, and Shane works at Micron, which is why I get to pick on him. The jobs and housing, jobs have been increasing, housing units have been increasing. So they've both been increasing in tandem in such a way that this is not creating a major seller advantage. They're looking pretty balanced. I'll add that we had last year, depending on which statistic you look at and how you crunch the numbers, maybe 40, maybe 50% of our home sales last year were new homes. Does anyone else have a statistic that's exact on that, or that they would, yeah, somewhere in there? And so this is what our employment chart looks like, thanks to Ted Jones, the economist for Stewart Title, who put together this amazing economic presentation. Hours long. You guys get like the meat and potatoes of it in like 4 minutes or less. So here you go. Jobs, bam, going crazy. Cost of living, competitive in Boise. So while we do have high prices of homes and we all wonder what's happening with affordability, we have competitive advantages here, as this slide shows. Cheap electricity. There you go. It's long-term positioning strength. Oh, also 9th overall in this country for lowest tax burden, and our property taxes are number 3rd for property taxes specifically, 3rd lowest. Migration. U-Haul has great data. Who's referenced U-Haul's data in the past? I've peeked into their website for years because you can just, they know which way the moving trucks are going because they only go one way, and they're going to Idaho. And they are leaving New York. New York has the worst in-migration right now of all the states. It's 50th. Homeowners are staying put longer. Well, who can afford to move? That could be one rationale, or there's plenty of rationales, but the average tenure went up a year from 10 to 11. And so this is being translated into a structural slower turnover, not just a trend. And recall, we've talked about this since, well, all last year. Not everybody has equity in their homes because we had that huge post-COVID spike. So people who bought in 2021 and 2022, I always get nervous when they're ready to sell because that was hard. Right now, timing, to Shane Trapp's point, is not in their favor yet. They bought at a moment they need a little more time before they can make money on that purchase. And sometimes you move. The reason people are moving is to move to be closer to family and to jobs. Those were two of the main reasons that people were moving. And interest rates. Was that you, Ray? Somebody said interest rates. Yep. He's not predicting meaningful interest rates cuts soon because inflation is still an issue that needs to be curbed. So he's got all sorts of formulas that he looked at that measure what should happen or could happen with inflation, and it translates into his prediction that rates are where they are. So what about wages? Can we keep up with this inflation? Here's the chart. Inflation is the blue line, wages are the red line. So, and you can see this is 2020 here. So we have had spikes in wages. We've got wage growth. We've got inflation growth. This is what the chart looks like. And according to the Don't Bank on Cheap Money, Ted Jones quote, here's our 10-year treasury yield, which is the #1 influencer of what interest rates are going to do. So, I mean, the rates have moved a little bit. I think I was referencing maybe our October, November slide, and I saw these numbers were a little bit lower. But single family home buyers purchasing a single family home are really close to 6% at their interest rate. And I think it's 5.875 on a 30-year fixed right now. And then we've seen a resurgence in those ARM loans. Okay. So any questions on the market update? Because if not, I'm going to invite Danielle Costa up to do the single family home, the Ada County and Canyon County slides.
Thank you.
You're welcome.
All right, so here is what is going on with, oh, that is much smaller than I'm used to.
I know. Good luck reading that.
Yeah, all right, we're just gonna go like this, even though I looked at them earlier. So here's what's going on in Ada County. Inventory, if you can see this number, it has gone up by 23.3% year over year in Ada County and 6.8% increase with the home sold. So with that, we are seeing that the median sales price has gone down, not too much, just a hair, and the days on market has gone up. Looking at both Ada County and Canyon County, you can tell that the new builds are greatly affecting these homes sold and the inventory. Popping over to Canyon County, you can see our median sales price went down. It's at $420 in Canyon County with 66 days on market. That actually increased quite a bit compared to Ada at 6.5%. And then we're just a hair up year over year with 271 homes sold, but 5.2% year over year at 958 in growth in Canyon County. So what we're seeing is it's been pretty stable with the pricing in both Canyon and Ada compared to last year. Not too much of growth. Days on market is higher, but pricing hasn't changed too much year over year. And I'm quick today, so I'm going to introduce Jocelyn, who is a part of our team and the short-term rental specialist.
Thanks.
You guys.
Just
Okay.
look back and then forward.
Back and then forward.
Yeah.
Back, forward. Okay. So what you're going to see today is a small snapshot of what we give to each of our homeowners. So I am the co-founder and operator of Capital City Comforts, and we're a boutique short-term rental property management company. Oh, yes. Hey, guys. So if you were here last month, you would have seen that I gave an overview of Boise market as a whole. And so now I'm starting to break down some of the submarkets. So we're going to dive into the north end. So it ranks, and we get this data from a few different softwares that we're plugged into that compiles all this market data that we're able to compile into these nice little slideshows and spreadsheets for our homeowners. But you can see it's definitely a great market. It performs 84 out of 100, which is great. You can see the average price per night is $153. And then the occupancy rate. So usually when we're doing these projections and people want to know, okay, what am I going to make January, February, annually? It's price per night, times the occupancy rate, which gives you the annual revenue. This also breaks down here what percentage of listings are in what category in terms of like size. So 43% of the listings in the North End is 1 bedroom. 28% of them are 2 bedroom, 18 is 3 bedroom, 7 4, and obviously small slice of the pie is going to be 5+ at 3%. And then what channels they are listed on and what percentage. So 51% of homeowners have them on Airbnb, 2% on VRBO, 40% on both. And then this is the growth in the last 3 years. So this growth chart is based on listings. So you can see each year there's quite a big dip in January. What I chalk that up to and what I would imagine is a strategy very close to what we do as well. A lot of the times in these slower seasons, usually depending, November to March, we use the midterm strategies a lot in those cases to where we're trying to get more like traveling professionals that are going to be there for 60 to 120 days. So that way we can make the occupancy and the turnover less in those winter months where you would be expected to make less because less people are traveling, right? So that's what I would imagine that would be, although you may want to fact check me, but that's
That's what I do with we
right.
And short-term rental, and that's exactly what we do with ours.
Yeah, exactly. And then occupancy rates over the last 3 years, obviously not a whole bunch of data yet here for 2026, but over 23 to 25, it's been very consistent with occupancy. And so the annual revenue and the nightly rate, what that chalks up to being is just over 2,900 a month annually.
For how many bedrooms? I'm sorry.
That's just market view overall.
Average of everything.
Average of everything. Yeah. So, and I did a very quick search, like I just asked ChatGPT, so don't hold a whole bunch of weight in this, but I did look up that the average like long-term rent in the North End was about 2,400 is the median. Obviously, that's very size dependent. If it's something smaller, probably going to get less, but if it's something larger, you can definitely get more. So for some of those median houses, 2-3 bedrooms, could be advantageous looking at a short-term rental because you could pocket a little bit more. So that is the market update for the North End. And if you guys have any questions, let me know. Yeah.
Are they more single-family homes that are being short-term rented or a unit in a multifamily?
That's a good question. Sorry, when you texted me and said you were going to ask that, I thought you were going to ask about our property specifically. Overall in the market, I'm not sure. It's definitely a good mix of both, but I don't know like if there's more of one or the other. Our portfolio, specifically speaking, we have 3 single-family homes, and then the rest are ADUs, apartments, or ADUs and apartments. So, and it's about like 50-50 for us. So I would say that it's usually a good split. It's kind of just dependent.
And for your portfolio, the people who short-term rent out single-family homes, do they have a specific motivation, like using it sometimes, or they needed to move, or what made them STR it?
I would say definitely like moving is a big one, and people like are out of the state, they don't want to worry about it. That's definitely a big one. But a lot of like for one of the properties specifically that we have, our homeowners, they live in California, but they're in the house maybe once a month. So for them, it's like flexibility of being able to travel back and forth. And then for another homeowner, they make significantly more on their studio apartment, believe it or not, off Maple Grove and Ustick, like in central Boise, exponentially more like short-term renting it than they would on a long-term lease. So it's kind of a little bit of it all.
And all your short-term rentals are fully furnished, I presume.
Oh yeah.
Okay.
Yeah, all fully furnished. We definitely like to cater to more of the high-end luxury offering, full amenities type of listing. But of course, we do a little bit of it all. So yeah, great questions. Any other ones? Yes.
Just kind of wondering about average expense ratio for short-term rentals. You got your management fee, you have your supplies, you have your utilities you're paying. Like on long-term rentals, depending on the condition of the property. It's newer, you might be like 25% a year, all in taxes, insurance, maintenance, repairs, etc. Older one might be like 30%, because banks will use 30 or 30, around 30%. What's kind of like the average off that annual revenue as a percentage for short term?
That
Industry average.
Yeah, that's a good.
Percent or
I would say depending on the property, usually it's probably anywhere between 15 and 25, depending on like who your management company is, right?
Yeah.
The reason why I say that is because with Capital City Comforts, like all of your furnishing replenishments, actually, let me retract that, maybe closer to 25 to 30, because you do take care of your utilities, you do take care of your Wi-Fi, but replenishments and all of that sort of thing, that's usually something that we handle. Not all property management companies do that. But like toiletries, replenishments, we take care of all of that. And a lot of like really good competitive property management companies really should.
Yeah.
So it's mostly just your utilities, Wi-Fi, and then lawn care is the biggest things that you guys would take care of, along with obviously whatever you pay for management. Did that answer your question?
Yeah, so
Okay.
taking the 35,000 average, minusing out 30%, that's kind of what's left to pay, like principal and interest if you have a loan.
Yeah.
And your cash flows, what's left.
Yeah.
And were you probably weren't
So I'll
factoring
lower
in
that
taxes and
top.
insurance in that are you factoring in like,
This is before this. Are you talking about like on the price per night?
well, no, for Bodie's question,
Oh,
because I think it sounds low to me too. And so I'm thinking when you're kind of doing your quick math on expenses and stuff,
mhm.
your owners paying their own property taxes and
Yeah.
insurance.
Yes.
And so those numbers might not be factored in that.
Yes.
Okay.
That's
Yeah.
why I say give a range of maybe like 20, 30%, maybe a little bit more, kind of just
Mhm.
depending on the
Yeah.
property. Yeah. Great question. Any other ones? Alrighty, well, I'm here if you have any other ones.
Expenses are higher, so revenue must be substantially higher to be a little bit lower expense ratio.
I'm sorry?
Yeah.
And so your expenses are
Yeah.
definitely gonna be higher.
Oh, yeah.
But your revenue must be substantially higher.
Yeah, exactly. And again, this is kind of an average, right? So it looks very different for every property, which is why if someone's like, okay, Jocelyn, I want to Airbnb one of my properties, what is that going to look like? This is a very macro of North End as a whole. We bring it down to your property scope based on how many bedrooms, how many bathrooms, what amenities that you have. That could obviously change these numbers pretty specifically or dramatically, excuse me. And then we tell people, what are your outlay of cost and what do you need to make? Because if you're going to make more long-term, we're going to tell you to go long-term. But if you can make more short-term, then obviously there's opportunity there. So yeah. Awesome.
Jocelyn Cubis, everyone, thank you so much. Short-term rental management.
Yes.
And we didn't clap yet for Danielle. Danielle, thank you so much. And if anyone's really interested on the short-term rental thing, I've done a pro forma because we have one short-term rental on our portfolio. And the reason we short-term rent it is because I don't want to live there. I don't want to know who wants to live there long-term. It's just too small, we have stuff. And so it's a studio above a garage. It's really cool. And it's great that it has no lawn of its own to maintain. So that keeps my expense low. And it's kind of in the downtown periphery. And so I knew what I could estimate for that on a pro forma as a long-term rental. I just kind of know what it would rent for and I wouldn't pay utilities. And then I know my actuals as a short-term rental. And really what I found is in that particular unit, I got about a 0.5% cap rate boost by short-term renting it. And maybe it's time for me to do that again because I noticed that, my income went up a little bit, but also I haven't looked at it since my expenses went up. And so for the amount of extra moving parts, for the amount of supplies, for the amount of extra humans in and out, it seems to me that if you're not being scrappy and getting started and like some DIY property managing your own place. Because obviously that'll open up a ton of, because STR management costs more. So that'll open up a ton of flexibility and a better expense ratio. But if you're not doing that, there should be some other compelling reason to do the short-term rental. And, or maybe it's your niche and that 0.5% really adds up for you over time. But for me, my reasons were we wanted to get to use the garage beneath it, and you'd have to give that to a long-term person. And as landlords, I used to have this little appliance problem. We all have our, bad habits, and I'd be like, what? Look at that's a free fridge, and so I got over that. It's fine. I grew up, but I had a little appliance stuff, and yeah, that garage really came in handy for that. Yep. Gifted my last one to a client. I was like, yeah, I need to not fall into the $100 washer dryer trap. So yeah, a case by case scenario is the way to go with those. So okay, so duplexes and fourplexes, moving from short-term rentals into multifamily properties. What's going on in that marketplace? We've already heard single families are newer and some investors are looking there, but we also have a lot of fourplexes and great duplex opportunities. A lot of people get started on duplexes as their first home. I think, Bodie, your first home was a duplex, was it, or
I
no?
wish it was.
Oh, okay. Well, mine was.
First rental.
Okay, first rental. So we have inventory decreased a little bit, and that's common for this time of year. Number of pendings went up a little bit, and sales went down, and absorptions a little bit up and a little bit down. So there's no super clear trends in the duplex and fourplex market in terms of these data point. There's around a balanced inventory, let's say. Tony Dross has run fourplex data for decades and looks at the trends and the long-term trends and the story behind what's going on in this fourplex market. And what we've found is in January, only one sold. So that's not a good data point, which is why we look at the 6-month trailing average. And the sale basically reminded him that value creation is not limited to maximizing rents. When we talk about the value of your multifamily and what it's worth, we got to look at your expenses and we got to look at your rents. And the income is something that people would historically fall behind on because rents were going up for so long. But let's move past that part of the story and look at nickel and diming expenses. In the face of a higher repair costs, nickel and dime expenses and just expenses can really add up and really drop your performance and your overall pro forma and your price. So the one that sold fairly quickly in 11 days, but 38 days is a lot more realistic right now. And the one that sold actually had a pretty good cap rate above 5%. And that really helped make it move fast. But that was the first time we've seen an above 5% cap rate since 2024, October 2024 to be exact. So our caps have been hovering just below 5. And our gross rent multiplier, again, that one was compelling, but our average is right around 170 these days. So here's what it looks like in pictures. The bar graph, the red is the 6-month trailing average on cap rates. So you can have an overall picture of what they've been doing and what they are doing. No sudden movements anytime recently. And the average price, no sudden movements. But we are just kind of keeping an eye on our overall expenses as they hit value. And here's our GRM line. The easy, quick, and easy data point to look at how the rents and purchase price compare. The lower the number, the better for buyers. And this is our days on market so far, but this was just January. So we'll see how that looks. We expect it to go up a little bit. And our slides are being a little goofy, so sorry for the little spazzies. But here's what we have active in Ada County right now. There's 8 active fourplexes. You can see that Danielle's Benjamin listing is right there at the top. Brogan, we don't look at those. If you're ever considering buying one, just don't. Or call me and find out why. Ustick has something, and there I know some others on Ustick right now that are really nice. And the super expensive ones we're starting to see are actually coming with some extra land to develop. So creative approach, sell the fourplex for super lot of money, get someone a loan on it, but it comes with the land, and then it's already entitled. Yeah. Here's what your Canyon County fourplexes look like right now. And I had a little note on that. Yeah, these are 2020. This is a good price here. If anyone's in the market for 3 fourplexes and you're looking at considering Canyon, I think that I would give a look to this 44th Street. I haven't studied it yet. I haven't had a reason to, but I'd love it if someone gave me a reason to look into these. It's right near the freeway, not too close, good access, and they're 2022 build, and they dropped the price from almost $1 million. And so this price looks really good. 2-bedroom units, 1.5 or 2 bathrooms. So that's the one that strikes me as the deal of the moment. Yeah. And then for commercial, here's what we're looking at. Above 4 units, we've got a few things out there. All those Victory Roads, that's part of like a 300 unit complex that they're selling. All right. Well, that's our market.